Good day, everybody. How's it going out there? Well, interestingly enough, during the shutdown, things have been a little interesting in our world. And obviously, there's an interesting thing going on in the stock market right now. And normally, I cover furry news and I cover anthropomorphic and animal news and such and such. So, to keep it on topic for this channel, I'm going to be talking about a concept that came out in 2019 that seems to have arrived again, and that is the concept of a kangaroo market. Now, CNBC came up with this animal thing, this kangaroo market. I swear I'm not making this up. This is a real thing, guys. So there's bear markets and bull markets. Those who are familiar with the financial world are familiar with it. Bear when stonks go down. Bull when stonks go up. And after the Corona crash of 2020, which I don't think that's its official name, but that's what I'm calling it because it's alliteration and it works. So after the Corona crash in late February and March of 2020, the stocks went down. It went down so hard that basically the index funds basically went back to the value that they were before President Trump even took office. It was crazy. And that's about where it hit, too. It hit right down at its lowest point, went down to where the stocks were before President Trump was inaugurated. And then it kind of started to come back up. And it recovered pretty rapidly. But at the end of in June 2020, somewhere around there, the stocks went down, hit hard, bounced back up in late March and April, and then May. And then in June and summer, it started to taper off a bit. And at that point in June 2020, the stock market, there was big debates on what would happen with the stonks. Would the stonks then continue to go up, or would the stonks then go down, right? Would the stonks have, and they called these things like a U-shaped recovery, U/V-shaped recovery, where it's like it's down and then it goes back up. It was kind of sort of running a U-shaped recovery. What goes down, it comes back up, but with less volatility than when it came back down. Or would it be what they called a K-shaped recovery, which is it hits the ground, it bounces back up, it reaches a tippity point, and then it goes down again before it kind of comes back up or kind of stabilizes one or the other. So there was a big debate between the U-shape and the K-shape recovery people. And during that time, because of that talk between these two particular camps on whether the bears would return or whether the bulls would come out in the end when it came to the stock market, something happened where at that apex with that kinetic energy, there was a sort of ups and downs, and it was very volatile. But it really wasn't going neither up nor down. At that time, CNBC and these finance channels called this a kangaroo market. And after what happened this week with the GameStop stonks, you basically have the same thing happening. This is a literal screenshot from my Robinhood swing trading account over the last week. And if there's no better symbology of what a kangaroo market looks like, I don't know what to tell you. Like, I've seen a lot of examples that they kind of gave to kind of emulate what a kangaroo market would actually look like. But this right here is so beautiful because it's like, it literally is. It's like my stocks went really high up and then they crashed down and then they really went up and then they crashed back down and then they're bouncing a little back up. So it's like, it doesn't know, which way do I go, George? Which way do I go? And it's just bouncing. So, in essence, this is a kangaroo market. And it seems like we're in a kangaroo market again as we go into the first week of February. People don't know whether it's going to go up or down. And it's thanks to the gamers trying to game the system against short sellers. So a lot of people probably have already gotten this from a lot of financial news channels. There's a lot of stuff on it flying around YouTube and the news and the press. So there's a lot of people that will be better at describing it than myself. And I don't want to reiterate what a million other people have already said. But in essence, there's some companies that are on their way down, and they're seen as basically companies on their way out, such as BlackBerry and GameStop and all these places. And so these hedge fund people are short selling, which is basically usually when you think of stonks, you think of, I'm going to buy stonk, and then the stonk goes up, and then I sell the stonk, and I make money. Or I buy the stonk and the stonk goes down and then I sell it and I lose money, right? The shorting, that's called a long position, by the way. The fancy, je sais quoi version of the market people saying, I'm buying and then I'm going to sell later, which is what a majority of people who invest do. Basically are people who long a stock. They go long. They think that in the long term the company will go up. Shorting is the opposite. I don't know why they call it shorting, but they call it shorting instead of sell, just say having sold or something. I guess that's what it's called, and that's why it's called that. I don't know the etymology. It'd be interesting to probably look up. I should probably look it up later. But shorting a stock basically is, I borrow a stock from this dude and I instantly sell it. As soon as it hits my paws, I'm like, boom, boom, sold, right? So I go up to my mom and I go, hey mama, can I borrow your car for a moment? And your mama's like, well, I'm not using it, I guess. I don't go anywhere these days because of coronavirus. Okay, I guess I can let you borrow the car. But you're going to have to pay a little bit of interest on it every day. I'll accumulate an interest rate. And you're like, oh, well, that's fine. And let's say this was a brand new car, right? And as soon as your mama gave you that car, you sold that car to some guy at the full retail value, right? You don't tell. Now, you're in the real world, the broker is knowing that you're doing this. We're just going to pretend that your mama don't know that you're doing this, though. In real life, though, if you're shorting a stock, your broker knows you're shorting it. Okay, that's why you're paying interest, and they want you to have margins so that way if you buy it back, that you're hedging your risk, right? Things like that. It's a lot of technical jargon, but let's go back to our simple example. Okay, your mama lets you borrow the car. You sold that car at full price, right? It's a new car. It's like a 2020 car, right? And so what you're going to do is, you told her that you're going to borrow it for an extended period of time, like 2 years or so. She's like, well, I don't really go out and do much anymore. I don't know why she would give you a new car. Don't think of the logic behind it. Just let's keep on with the metaphor, okay? You can't really do that with cars anyway. Okay, I know that because they're licensed to people and stuff. Okay, we're trying to make this simple, okay? Your car, you sold your mama's car to somebody at full retail price, okay? And basically, you, as the person, are going to go, well, I'm going to buy a car of the same make and model, right, for this a cheaper price 2 years down the road, and then I'm going to give it back to my mama, right? And somehow make it so that she doesn't realize it's not her own car. But it is a similar make and model, so it's apples to apples, right? I mean, obviously in cars it's not the case. You have licenses, I said, but it's a metaphor, okay? Anyways, that is how it works. And basically, you would buy it when the car price depreciates. You would buy it using the money that you sold it for, and then you would keep the difference, right? So when you sold that car of mama's, you made $30,000. It depreciates 2 years, and let's say you get it back for $15,000. You buy a similar make and model for $15,000. And then you just give the car back to your mama, right? But because you got $30,000 for the original car that she gave you, and then you basically have the $15,000 that you paid $15,000 of that $30,000 to buy basically a similar car and then give it back to her, you made $15,000. That's what shorting a stock is. It's betting that the cost of a product will go down. And in most cases, in our real world, most solid things you buy go depreciate in value. Fursuits depreciate in value. What? Yeah, I know, right? Oh, no, I invested too much in fursuits. But most solid items in our world either have sentimental value or have things, so the cost versus what you can sell them for is different. So cars are probably the most infamous depreciating asset. Your television is a depreciating asset. Your furniture is a depreciating asset. Your refrigerators are depreciating assets. Usually the only really things that go up in value are usually these things right here, these houses, right? If you buy a house, then it's usually an appreciating asset. Sometimes it can depreciate though. Housing prices can go down if something happens like nearby where like maybe an environmental disaster happens nearby or something, and basically people don't want to have don't want to have sprout extra fingers or something, and so the area becomes pretty toxic, like a Chernobyl or something, Chernobyl, right, or something like that. Like all of a sudden the value of your houses and the property is going to plummet because you didn't take care of the environment in that area, right? So your house can depreciate in that way. So short selling is basically saying, hey, I don't think this is going to do so hot in the future. And so there's a bunch of people, but unfortunately, let's take that example with Mama again. I sold that car for Mama for $30,000. Let's say all of a sudden the car is seen as like this super classic and super rare model that has some extra features. Maybe some by some engineering mishap, the car has like some stupid like replicator in the back that no one knew about until like somebody found one, and they're like, oh, these cars have replicators, and you can make like chocolate and like make Earl Grey tea just pop out of nowhere out of the back of the car, right? Obviously I'm being silly, but something happens to the car that makes it a lot more valuable than it was originally assessed at. And what happens is the car price goes up, and you still owe your mama a car, and you're still paying interest on that car, and your mama comes to you and she says, hey, the car I gave you is actually, and she's smart, your mama's smart, she says, that car that I gave you is more valuable now, so that interest rate that I gave you, I'm going to peak it up a little bit. And you're like, okay, mama, I'll get you that car. God dang it, I can't find this car anywhere. Right? So this is what happens this is the short squeeze, is when people start buying stocks and then the shorters can't really move from their positions because they trying really hard to find that PS5. I mean your mama's car. And they're trying to find it. and all this stuff. So that's sort of the dynamic that's happening here. And obviously, this came out with its all fault. A whole bunch of fallout came from the story about stockbrokers, not selling stocks to other people and stuff like that. And it's a whole big old mess. So instead of boring with you here, I'm going to do something different. I'm actually going to shed off a different channel because I've grown interested in this kind of stock thing, and I like it's interesting stuff to think about and talk about. So I could talk about it for a long time. So and by the way, this is sort of a hobby I picked up during the coronavirus because I'm like, I might as well pick up a new hobby or something, and this was it. Learning about risk and management and all this kind of stuff. So I become a pretty strong, but in my opinion, currently I think I'm a pretty strong retail investor. So because people are now interested in this kind of topics, I think finance literacy and talks like that are very uncommon in the fandom. The fandom doesn't like to talk about money for obvious reasons. Like we're usually on the short end of the stick. But I think that not empowering yourself with this knowledge can help you do things to help enrich yourself, as I think the GameStop situation sort of proves. So I'm creating a new channel called Fuzzy Finance. You can click up there to find the channel, and I will go over more advanced topics or more and just kind of, it's sort of entertainment style, kind of based on my thoughts about the news. So I think it'll be of interest to people who, are interested in this sort of finance stuff. It might not be a good thing for this target audience, but I tied it back to me because it's a kangaroo. It's hopping. See the animal there? It's so cute. Look at this hopping kangaroo, just hopping away. Kangaroo Markets, Kangaroo Markets, Kangaroo Market's all right. So basically, that's all I have to say about this for right now. So that's Kangaroo Markets, and the cause of this sort of Kangaroo Market resurgence has been this GameStop short selling situation where hedge fund shorters are fighting retail investors, and retail investors are trying to push the prices up. They're basically doing, okay, like here's literally what they're doing. Gamers and GameStop buyers are literally doing to the short squeezers what the basically scalpers do with the PS5, right? Like the scalpers buy all the PS5s and then they increase the price on them, right? Because there's such a high demand and there's such a short supply, they increase the price, so they try to make a profit because they bought it for $500 and they're trying to sell it for $1,000. But in this case, let's picture this: if you don't, let's say you want a PS5, but let's say if you don't get a PS5 and they keep driving up the price, at some point someone forces you to buy it at the highest price that the scalper lists. Like basically, you know, they scalp it, and you're forced to buy it. And like if you don't have a certain amount of money on hand, like someone's going to force you to buy it. And so basically you need to prove that you have enough money that you can buy the most expensive PS5 possible to your broker, because you shorted it, right? Because you owe them a PS5. You owe them a PS5, and as that PS5 price gets higher, you owe them it, right? So they're gonna say, well, you get us, like, we're gonna, if you can't prove that you can hold it, right? And that's when it comes to like realized gains and losses, right? If you sell out, if you do buy it after you short it, then you realize your losses or gains, right? Just as similar as if you buy a stock and you hold it, you don't realize that loss until you actually sell it. The value of the stock may go down, but you still own one. You still own one stock until you sell it. And as soon as you sell it, you get off the ride basically, and you gain or lose whatever you gain or lost. And that's the same for shorting. Same on the other side. So right now these guys are trying to hold, right? The hedge fund managers are trying to hold their shorts. They're holding their shorts even though they're not comfortable and easy to wear anymore. Sorry, the youngsters are like, that's blasphemy. But no, the shorts are not comfortable and easy to wear. They're trying to hold on as much as they can to these, and so they don't lose their shorts. But the people who are like longing for GameStop are buying GameStop stock are trying to make them eat their shorts. Okay, so basically that's why it's a fight. And like with most fights, there are people on both sides that are going to take some damage. And who comes out in the end, who knows? But I do, on that financial channel, I do have, it's like I don't like to pick sides, but I like games, and I like video games, and I like GameStop, and you know, it was a part of my childhood. I liked Electronics Boutique too, but they kind of got bought out by GameStop. But you know, I do have an opinion about what GameStop can do in this situation, and the retail investors who are activist investors can do in this situation, and that'll be a video up there. I won't drag it on too long here because I just wanted to talk about. Oh, look at the pretty kangaroo. Look at the kangaroo. Aww, isn't he so cute? The kangaroo. Aww, Kangaroo Markets. You know, the funny thing is like they called it a Kangaroo Market, and that's like I picked up, you know, trading as a hobby in 2019. And then like a year later, it's like, oh, we're in Kangaroo Markets. It's like, oh, then I should do very well then. I should be like, this is my home turf now, buddy. Like this is like Kangaroo Markets are where I'm at. I'm all for Kangaroo Markets. What do you think? Actually, Kangaroo Markets aren't really good in the long run. Just let's be real. I think the most famous example of a long-term Kangaroo Market would be the Japan what they call the lost decade, and you can Google that to find out more information. But basically, you know, stocks neither went up nor down. It sort of plateaued and sort of had the ups and downs, but it didn't really, gain at the end of the day. So you could do your own research on that. But thank you very much for watching. I promise to get back to more furry content for this channel. But if you want to see me nerd out about finance stuff, go ahead and click on the Fuzzy Finance and subscribe there. I'll keep these things separate, and it'll give me something to do. I find this stuff interesting, and I've gained a lot of knowledge over the past year and a half, and I think that knowledge will be helpful to others who are from the outside looking in, because I was on the bad side of markets and during the Great Recession, and on this time I was fortunate, absolutely fortunate, to be on a side where I had gained up enough assets over the past decade where I can weather this storm a lot easier than I did in 2009, because 2009 was horrible. It was, so I know what it feels like. Not unlike those hedge fund people. I know what it feels like to lose your job, think that you got out of college and just got out in the real world, and the real world beats you down because of some invisible line out there, invisible hands just strangling you. Right? I understand that feeling, and I think that the more people are financially literate, the less often that people can mislead you and put you into positions that is in their favor and not yours. And I think that my hope is that that is what my channel will help do, even if it's a bit technical and nerdy. But anyways, thank you very much for watching this week. As I said, I'll get back to regular, more furry-ish content next week. Thank you very much for watching. Kick that like, kick the subscribe button, kick a comment in the comment section. And be sure to check out Fuzzy Finance. Thanks. Have a good one. Incurred.